Hi everyone, welcome back to our channel. Today we have some exciting updates from the world of finance and cryptocurrency that you don't want to miss. Let's dive right in. In a groundbreaking move, the White House has launched a strategic Bitcoin reserve, holding a whopping 200,000 Bitcoins, valued at around $17 billion from seized assets. This initiative, announced at the recent Crypto Summit, is backed by an executive order directing officials to expand these holdings. This positions the US as a potential leader in the crypto space. This signals a clear pro-Bitcoin stance amid ongoing calls for regulation. However, critics are raising concerns about the need for transparency and oversight to prevent any misuse of these assets. This reserve reflects Washington's evolving crypto policy and could have broader implications for financial markets and the adoption of digital assets. Next up, the Senate Banking Committee is gearing up to vote on the Genius Act, a bipartisan bill aimed at regulating stablecoin issuers. This legislation proposes federal oversight for issuers with a market cap exceeding $10 billion, while smaller issuers can opt for state-level regulations. Sponsored by Senators Hagerty and Scott, the Genius Act aims to strengthen consumer protections and enhance transparency in the stablecoin market. If passed, this could significantly advance President Trump's crypto policies and reshape the industry by clarifying compliance standards for stablecoin operators. In other news, Standard Chartered has issued a warning regarding the potential for a US recession, attributing it to Trump's tariffs and economic policies. Despite expectations of growth, the S&P 500, Dow, and Nasdaq have all seen declines as markets brace for 80 basis points of Fed rate cuts. Kaushik Rudra, head of fixed income research, pointed out that these tariffs are inflationary, exacerbating economic instability. Investors should prepare for heightened volatility and a shifting macroeconomic landscape under Trump's administration. Let's talk about personal finance. Robert Kiyosaki, the author of Rich Dad, Poor Dad, claims that the biggest crash he predicted has finally arrived. He warns that baby boomers' retirement savings are at risk due to failing pension systems and poor financial education. Kiyosaki advises investors to steer clear of ETFs, labeling them as fake, and instead suggests investing in gold, silver, and Bitcoin. He attributes the current economic instability to excessive money printing and flawed investment strategies. Finally, Japan has recorded its first current account deficit in 2 years, driven by a weaker yen that has increased import costs. The January deficit hit 257.6 billion yen, surpassing forecasts, with imports surging 17.7% year-over-year. This shift from last year's surplus of 334.3 billion yen highlights the impact of currency-driven trade imbalances. Government data reveals growing economic pressures stemming from currency fluctuations and global supply chain shifts. Let's look at the economic indicators for this week. First up, the JOLTS job openings for January came in at 7.74 million, slightly above the forecasted 7.65 million, and up from last month's 7.508 million. This suggests strong hiring demand which could lead to wage growth and inflationary pressures. Turning to the energy sector, the API weekly crude oil stock saw an unexpected build of 4.247 million barrels, much higher than the forecasted 2.1 million. This signals weaker demand or increased production, which could put downward pressure on oil prices and help ease inflation concerns. Inflation is a key concern for both the Federal Reserve and the markets. The core CPI month-over-month for February came in at 0.2%, slightly below expectations of 0.3% and a drop from last month's 0.4%. This suggests inflation is stabilizing, which could influence the Fed's future rate decisions. The headline CPI year-over-year was reported at 3.1%, slightly below the forecasted 3.2% and last month's 3.3%. This signals a slowing inflation trend, potentially reducing the likelihood of aggressive Fed rate hikes. Looking at CPI month-over-month for February, the report showed 0.2%, slightly below the expected 0.3% and a significant drop from last month's 0.5%. This suggests inflation remained stagnant, which may indicate stable consumer price growth. However, it is still about the Fed's 2% annualized target, meaning inflationary concerns aren't completely off the table. Crude oil inventories reported a 1.448 million barrel increase, lower than the expected 2.1 million, suggesting stronger demand or a tighter supply, which could put upward pressure on prices. Bond yields provide insights into market expectations for inflation and interest rates. The 10-year note auctions saw yields at 4.31%, down from the previous 4.632%, indicating increased demand for bonds, often a sign of softer inflation expectations and potential rate cuts. On the jobless claims side, continuing jobless claims came in at 1.87 million, slightly below the 1.9 million forecast, while initial jobless claims were 220,000, lower than the expected 226,000. These numbers point to a resilient labor market, reinforcing economic strength despite potential monetary tightening. Meanwhile, the Producer Price Index for February showed 0.0% month-over-month growth, compared to the expected 0.3% and last month's 0.6%. Weak cost pressures at the producer level could translate into lower consumer inflation down the line. The 30-year bond auction yielded 4.62%, lower than the previous 4.748%, reinforcing the sentiment that investors expect lower future interest rates. Finally, a quick look at the Fed's balance sheet, which now stands at $6.757 trillion, a slight increase from $6.760 trillion. While the Fed has been reducing its balance sheet under quantitative tightening, this minor uptick may reflect short-term interventions in liquidity. Next week, market attention will be focused on key economic indicators and earnings reports, including core retail sales month-over-month, Fed interest rate decision, initial jobless claims, and existing home sales. Also, several major corporations are set to release their earnings reports, including General Mills, Lennox Corporation, Five Below, Signet Jewelers, Ollie's Bargain Outlet, ZTO Express, Maravai Life Sciences, Tencent Music, KE Holdings, and Huya Incorporated. That wraps up today's financial news. What do you think about the White House's Bitcoin reserve? Are you concerned about the potential recession? Let us know in the comments below. Don't forget to like, subscribe, and hit that notification bell for more updates. Thanks for watching, and see you next time.